Hi to all. So in this video, we will continue. We have already covered bull spreads, but now we will focus on bear spreads. So basically, bear spread is the opposite to a bull spread in the sense that in a bear spread, you make money when the stock price moves down, right? And if the stock price moves up, if above the strikes, then probably you're going to lose money. So how can we think of a bear spread? Let's just keep in mind a bear spread. We are buying a high strike. I'm gonna call this once again X, and now we're going to say this is X2 because we're buying the high strike. And let's say this is option. Let's think about call option. And because this is bear spread, let's start with put options, right? Put, and then we are selling the low strike. Let's call this X1 put. Now this put, because it has this put here, because it has strike 2, we're going to call this put 2 or P2. And because this one has the strike X1, we're going to call it put 1 or P1. Now, how can we calculate the profit from a bear spread? Let's assume with put options once again. So the profits can be calculated like this. We got to keep in mind that we bought the high strike put. So in other words, we paid the premium of that high strike put option. Okay. Now, because we bought the high strike put option, then we are also entitled to, or in other words, if that put option gets in the money, we're having a positive payoff, right? So we're getting this max of the strike, and the strike is strike 2 minus whatever the stock price is, or 0. So if it is in the money, that means that the strike will be higher than the stock price, so this number will be positive. Now, this is our long component of our portfolio. We also have a short component, or in other words, we are writing or selling the low strike. So that means we sold the low strike put 1, which has strike 1, and we are selling that, so that money's we're receiving that money from some investor. And because we sold that put option, if that put option gets in the money, we will lose an amount of money that will be equivalent to the intrinsic value of that put option, which is X1 minus ST. Okay, so what we will do is now we will quickly move to the Excel so we can put these numbers in the Excel. So the steps, and we have them down here, are the same that we have followed before. Number 1, get the intrinsic values. Number 2, get the profits. Number 3, adjust for contract size. So let's get the intrinsic values. Let's keep in mind now we're working with put options and this is a bear spread, right? But let's get the intrinsic values just like that first. Intrinsic value will be max of strike price 1. This is P1, right? And let's lock this cell minus the stock price, or 0. And then we can scroll this down, and that's it. Now let's calculate the intrinsic value of this put option 2, P2, which has a strike X2, which is the high strike price. So it is max of strike, we lock this cell, minus the stock price, or 0. And I lost this, so let me do this again. Max of strike 2, we lock this, minus the stock price, or 0, 0. And then we just scroll this down as well. Now we have the intrinsic values of both P1, put option 1, which has the low strike X1, and we also have the intrinsic value of P2, put option 2, which is the put option that has the high strike X2. Now let's get the profits. So how can we get the profits? Well, because this is a bear spread, keep in mind in a bear spread, you're buying the high strike put and you're selling the low strike put. Okay, so keep this distinction in mind. In a bull spread, you're buying the low strike, you're selling the high strike. Buying low strike, selling high strike. In a bear spread, you do the opposite. You buy the high strike and you're selling the low strike. Okay, so because we're buying the high strike, we are paying the premium of that put option that has the high strike. That is P2, put option 2. And because we are buying that put option, now whatever the intrinsic value of that put option, I'm sorry, we're buying that put option, so minus we pay the premium. So we pay the premium is here in cell J7, right? So once again, we buy by paying the premium and we lock this. After we buy the put option that has the high strike price, that's P2, well, we are entitled, or if this put option gets in the money, we will gain a payoff that is equivalent to the intrinsic value. So we get the intrinsic value. Next, we're going to sell the low strike put. So in other words, because we're selling the low strike put, we're receiving the money that is equivalent to the premium of the low strike put, which is this premium P1. We lock this. And of course, because we're selling this, somebody paid that premium to us. Then if that put option gets in the money, then we will lose, we will have a loss equivalent to or equal to the intrinsic value. So we subtract whatever the intrinsic value of this low strike put is. Then we just scroll this down. It is not surprising, this is a bear spread, so if the stock price is going down, you're gaining money. If the stock price moves up, you're losing money. We make the adjustment for contract size, so we just multiply this by 100 and then we scroll this down. And this is the shape uh, how a bear spread looks like, right? So if you don't know, this is very simple. You just select this contract, insert, you select this line chart here. There you go, right? And then we need to add that, and then it's just a matter of scaling it, right? If you scale it enough, it will look like that. Now, in the book, your figure also includes, once again, just like in the case of the bull spreads, what happens if I had only invested in that put option that has the strike of 130. So if you want to test that, then if it's a put option, you're buying the put option that has the high strike. So you're paying that premium, you lock this. And because you bought this put option 2, which is the put option with the high strike price 130, then if the put option gets in the money, you are getting these, you're getting the intrinsic value. So you can add that P2, the intrinsic value here. Then of course we need to multiply all of this by 100, and then that would be the profits if you had only invested in the put option. So that is how you have it in your book. That's why at the same time, that's why this the scale changes. So the bear spread looks like this, because we are also plotting this put option that has potential gains that are far above the potential gains that we can get from a bear spread, right? So keep in mind, with a bear spread, we have much lower losses, much lower potential losses that compared to a put option, but at the same time we have lower gains compared to potential gains from the put option.